As a capitalist society, we have a need for funds that is supported and enabled by a strong and dynamic banking system where there's lots of competitors and lots of opportunities to access the services that entities of all kinds need to get access to. The ability to save money and build wealth, the access to loans that provide for employment, that put people in homes.
We have never acquired another institution. We're not an organization that has grown through acquisition. We've grown organically through our markets, through our community's growth. In fact, if our communities don't grow, we don't grow. It was our consistent approach to delivery, to serving our customers, to serving our communities that sustained us and allowed us to build for the success we're seeing today. And so it was that commitment to remaining locally focused that allowed us to be successful. Current legislation creates some difficulties in our industry, specifically in community banking, relative to the impact on our ability to serve our communities. One of the things that we have seen come out of the recent legislation, Economic Recovery and Regulatory Relief Act, is an open dialogue, one that has created an ability for us to engage with our regulatory agencies in a manner that hasn't been there as much in the past.
Due to our size and our ability to garner funds, our cost of funds are a little different than the large banks. It affects everything we do from a spread standpoint. Some of the regulations also affect what we do and the expense that we have to go through to comply with the regulations. And they're definitely not tailored to small banks. I know there have been some efforts along those lines to make them a little easier for small banks to swallow and to comply with.
Challenges that were created by Dodd-Frank as we made mortgage loans, as we made business loans, as we met regulatory expectations from serving the customers that relied on us. It meant reduced business lending. It meant more difficult and costly mortgage lending, home mortgage lending for residents of our communities. It made it more difficult to provide first-time homeowners the opportunity to own their own homes. So the benefit to us was really on both sides.
Just the amount of time and expense going into preparing for this was 2 times to 3 times more than anything that we've done in the past. I think that at the same time that they were trying to roll that back, the government was also changing at the same time. So you had a fundamental shift in policy. Policy going into Dodd-Frank was we had this great catastrophe. We want to make sure that this doesn't happen again. One, either we need to collect more information for the government so that we can monitor, and at the same time so that the consumer then can protect themselves from large banks and the practices that led up to the crash. Our financial institution our size has to conform to the requirements of a larger bank.
So my recommendations would be understand the true costs of compliance and the regulations that you're providing or you're asking smaller banks to bear. We're not as large as our brethren, and we don't have a more unlimited amount of funding to be able to use to comply with those things. We have limited staff, and we do our very, very best to comply and make sure that we treat all our customers fairly. If we understand that, then they can tailor those regulations a little better to smaller banks.
I would say the main changes have been the additional regulatory reporting that we've had to do since Dodd-Frank. And while Agrippa is supposed to maybe roll that back a little bit, again, we're not going to see a significant change because a lot of the provisions in Dodd-Frank, while it required many more forms and information to be provided, the Agrippa provisions are actually very specific as to what they're rolling back on some of the reporting, and it's just not stuff that we're doing anyways.
What I believe that Agrippa was trying to do was to find that threshold that said this is a community bank we would like to provide that economic relief to this particular section of the economy or the industry. We just happen to be right there on the threshold. So a lot of the things that they were looking for from a consumer compliance perspective, we just missed. So it's going to, until we get to the economies of scale, we're going to incur more consumer compliance costs.
So we don't really see a huge financial impact in some of the Agrippa changes. We see actually it hurting us in the competitive edge, where again, it frees up the larger banks to do things more competitively against us. I think what we talk about is common sense. To apply more common sense, that a bank our size at just under $1 billion is a different animal than one that now they've classified us in the same pool as maybe up to 10 billion or 50 billion. You know, we would have the same rules in different areas, and it makes no sense. We will probably take advantage of a few of them that'll maybe save us some time personnel-wise. Again, the financial impact will be minimal. The savings we anticipate are only time saved with our individuals who do some of the work. The larger banks were doing those trades, you know, at a clip of 99% of the market, but we're really limiting then the smaller banks as to what they could do because of the big guys getting out of hand. So again, it seems like the best legislation for community banks would be, again, apply the common sense rule. Like, we're not contributing to the issues, so we should be regulated the same as the people that are.
What the original proposal was for modernization, relaxation of some of the rules and constraints of Dodd-Frank, there are a number of areas that remain to be addressed. Without going into them all, I can say we rely on a dynamic banking system in this country to generate the kind of prosperity that we all hope for, and to the extent that there remain obstacles to banks fulfilling the expectations of their customers rather than the expectations of Washington, there's more work to be done.
There's still some things up for interpretation, and we're not sure where things will end. It is our hope that ultimately the legislation brings a lesser burden and a more tailored approach to regulating our industry and our community banking focus. But the real benefit to date has been around the open dialogue and the communication that we've been able to establish with our regulatory agencies. So we're very pleased with the progress. It means good things for our communities. It has meant great things for the economic recovery that we've seen in the United States and specifically in our local communities and our small businesses. But there's more to come. There's more regulation discussion, there's more tailored approach to be looked at, and hopefully through this legislation and the interpretation of it, we will continue to see benefit.